If your retirement money is split 60% stocks and 40% bonds, it's that classic 60-40 mix. You know what? This can be perfectly reasonable when you're 55, and it can still leave you exposed at 65. It's not because the investment suddenly turned bad. Just one thing has changed. Now you're taking money out, and that one shift from adding money to withdrawing it is the part that almost nobody explains to you, and that's the part that matters most. Look, stick with me, because by the end of the video, you'll know exactly what question to ask instead of, hey, what percentage should I be in stocks? Let me tell you about a friend of the channel. Retired at 62. Did everything by the book, that same 60-40 split, rebalanced every year exactly like his advisor told him to, and then 2 years into retirement, in the same year the stock market dropped, his bond allocation dropped as well. Both halves of his portfolio, the growth half and the so-called safe half, they fell together, and that's not supposed to happen. That's the entire point of owning bonds in the first place. When stocks zig, bonds are supposed to zag, and they didn't. And once you see why, you'll understand something about your own plan that most retirement advice just skips right past. Look, here's the mechanism, and really it's simpler than it sounds. Bond prices move opposite to interest rates. When rates rise, the price of the bonds you already own tend to fall. Why is that? Because new bonds are coming out issued at higher and more attractive interest rates. For most of the last 40 years, when the economy got shaky and stocks fell, interest rates were usually falling as well. So bonds rose, and the safety net, it worked exactly like it was supposed to. Then 2022 happened. That year exposed the weakness that nobody was talking about. Stocks in 2022 fell 18%. Bonds fell 13%. The two assets that were supposed to balance each other suddenly moved in the same direction. That's called correlation. That correlation has come back down since then, but 2022 proved something really important. Owning stocks and bonds doesn't guarantee diversification when you really need it most. Look, when that correlation turns positive instead of negative, it doesn't mean bonds stop being useful. That's not true at all. Bonds still pay you income. They're still usually calmer than the stock market. What it means is that the one specific job that retirees count on that 40% of the bonds to do, to rise or at least hold steady exactly when stocks fall, it becomes a lot less reliable right when you need it most. Now, think about what that meant for this friend of the channel. He wasn't reading Federal Reserve reports. All he knew was when he opened his account in a year, the market was already scaring him. And the part of his portfolio that was supposed to be his cushion, it shrunk too. And when you're retired, that's not a number on a screen that you can just shrug off. That's money you may have to withdraw from that month, locked in at a loss, because the mortgage and the grocery bill, they're not going to wait for the market to recover. Now, here's something almost nobody connects to this. If you have a 401k, there's a very good chance you're not even manually holding 60-40 anymore. What are you doing now? You're probably holding what's called a target date fund. That's become the default option in most workplace plans now. The one, with the year in the name, like a 2030 or 2035, matching roughly when you plan to retire. A target date fund, it's really just an automated version of the same 60-40 idea. It starts out mostly in stocks when you're young, and it gradually shifts toward bonds as your target year gets closer and closer. That gradual shift, it's got a name. It's called a glide path. And by the time you actually reach your target year, most target date funds land somewhere close to that same old principle. 60-40, sometimes even 50-50. We've been talking about that split. So if this video applies to you and you've never touched your allocation because, hey, don't worry, I'm in a target date fund, so it's all handled. This applies to you too. The fund is managing the mix. It's not managing your withdrawal plan. Those are two entirely different jobs. And only one of them is on autopilot. Look, let's walk through what a 60-40 or your target date fund is actually supposed to be doing for you at each stage, because the job changes even when the fund doesn't tell you that. Look, 10 years before retirement, what's the objective? It's still mostly growth. You're not withdrawing any money yet. A market drop here is actually fine. It may even be good because you've got a decade for it to recover. And you may still be buying in at lower prices. Fast forward 5 years before retirement. What happens? The objective, it's starting to shift. This is where sequence risk enters the picture for the first time, because a bad market in the first 5 years right before you retire can permanently shrink the number you actually get to retire on. Look, this is the point where a generic glide path and your specific plan should start to diverge based on whatever your actual number is and not just your age. At retirement, the objective changes completely. It's no longer about growing the largest possible number. It's about producing reliable income from that number for the money you may need to touch in months, not years. 5 years into retirement, the objective is protecting what's already working. You've likely been through at least one down market by now. The plan should be able to show you, hey, in real numbers, whether your withdrawals are sustainable, not just whether the account balance still looks okay on a statement. 4 different jobs. One static percentage almost never does all 4 of those very well. Look, that's not a knock on 60-40 or even on target date funds. It's the honest limit of what a single number held constant was ever able to do. Look, here's the one sentence I want you to remember from this whole video. A 60-40 portfolio doesn't know and doesn't care whether you're 45 and still contributing, or let's call it 67 and withdrawing every month. It's the same split either way. That's the actual mistake that nobody talks about. Again, not that 60-40 is bad. It was built and it was popularized for people who were adding money, and then it handed unchanged to people who are now taking money out. Those are two completely different problems, but using the exact same allocation. If your portfolio, let's use an example, drops 20% in year 1 or 2 of retirement, and you're also withdrawing from it to live on, what does that mean? What's the math on that? You're selling more shares to generate the same dollar amount you need to withdraw. What happens? You lock in a loss the way you never would have if you were still working, and you could just ride it out. That's called sequence of returns risk, and it's most dangerous in exactly the years right when you stop collecting a paycheck. Nobody sat our friend down and said, look, this rule assumes you're still working. Why would they? He learned 60-40 the same way. Almost everyone does. This universal rule, not a rule for a specific stage of your life. It just never got updated for the one stretch of years when it absolutely mattered most. Look, if you want to see where a gap like this might be sitting in your own plan, look, I built a free tool for exactly that purpose. It's called the Retirement Reality Check. Drop your email over at brainflash.com and it comes free of charge straight to your inbox. Now, here's what I would actually look at instead of one fixed percentage. The better question isn't what percentage should be stocks versus bonds. It's not that at all. It's when do I actually need this money And does where it's sitting match that timeline? This is really just common sense once you say it out loud. Money you need soon should be somewhere calm, secure, safe, not keeping you up at night. Money you don't need for a long time can afford to ride out the bumps because it has time on its side. You already think this way about almost every other part of your finances. Nobody puts next month's rent money into something that could drop 20% overnight. We just always apply that same logic, that same common sense to the money we're planning to live on for 30 years. In practice, this usually looks like what's called a bucket approach. Money you'll need in the next 1 to 3 years sits somewhere genuinely stable, calm, peaceful, letting you sleep at night. Think of short-term, lower volatility holdings that won't get hit the same way by rising rates. Money you won't touch for 10 plus years, it can stay more aggressive because it has time to recover the same way it always did back when you were working. And the other half of this, the half that most people skip, is building some flexibility into what you withdraw, not just into where the money sits. In a down year, that might mean what? Pulling a little less from the portfolio and leaning on that short-term bucket instead of selling investments while they're depressed. That flexibility, it protects you in a way that rebalancing a fixed percentage once a year will never be able to do. Look, none of this requires predicting the market or getting clever. It requires matching your money to when you'll actually need it, which again is common sense. It's just not the rule most of us were handed. So this next part matters as much as anything else in the video. None of this works if you set an allocation once and never look at it again. Look, I'm not telling you to sit down with a financial advisor every single quarter. Most people don't need that, and most people won't do that anyway. What you need is a plan, a real one, written down, specific to your life, your numbers, and a simple way to measure your actual results against that plan. Look, that's a different habit than checking your account balance. Checking the balance tells you if the market went up or down. It doesn't tell you whether you're still on track for what you actually need this money to do. Cover your expenses as long as you adjust when life changes. Once or twice a year, sit down with your plan and ask a simple question. Based on what I'm actually seeing, am I still on pace for my goals? Or has maybe something shifted enough that I need to adjust? That's it. That's the whole habit. It's not about watching the market every day. It's not about letting years go by on autopilot with a plan or a target date fund that was built for a version of your life that you already have moved past. So don't leave this video asking whether 60-40 is good or bad or whether your target date fund is the right one. That's not the right question. In fact, it's the wrong question. And honestly, it's the question that kept most people from ever looking closely at their own plan. Look, ask a better question. If the market fell tomorrow, would your next 2 or 3 years of withdrawals, where would they come from? If you know the answer, the exact percentage matters a lot less than you've been told. Now, if you don't know the answer, look, don't panic. There's not a reason to get scared. That's just the one gap in your plan that you need to work on closing starting today. This is Brain Flash.